On May 9th, 2019, Cardinal Health reported earnings results for the third quarter of fiscal 2019, which ended on March 31st, 2019. This video provides an update on the company's dividend safety using its most recent operating results. To begin, let's talk about Cardinal Health's business model. Cardinal Health was founded in 1971 and is one of the largest healthcare supply companies. The company serves over 24,000 pharmacies in the US and more than 85% of the country's hospitals. Cardinal Health distributes branded and generic drugs and consumer products to hospitals and other healthcare providers. The company also distributes medical, surgical, and laboratory equipment to hospitals, surgery centers, and clinical labs. Cardinal Health has a market capitalization of $13.3 billion, with annual revenues of nearly $127 billion. Cardinal Health is one of the world's most popular dividend growth stocks. The company's current dividend yield is 4.4%. Moreover, Cardinal Health is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 34 consecutive years. Because of this, Cardinal Health qualifies to be a member of the Dividend Aristocrats, an exclusive group of dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors interested in owning Cardinal Health stock will likely be interested in the safety of the company's dividend payment. For the remainder of this video, we will discuss Cardinal Health's dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Cardinal Health's dividend safety in the context of the company's current earnings. In the third quarter of fiscal 2019, Cardinal Health generated adjusted earnings per share of $1.59, which compared favorably to the $1.39 of adjusted earnings per share in the same period a year ago. For context, Cardinal Health currently pays a quarterly dividend of 48 cents per share, which implies a payout ratio of 30% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Cardinal Health generated $4.17 of adjusted earnings per share through the first three quarters of fiscal 2019. The company distributed $1.43 of common share dividends during the same time period for a dividend payout ratio of 34% in the full fiscal year. Using earnings, Cardinal Health's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Cardinal Health's current dividend payment to its free cash flow. Cardinal Health generated $1.5 billion of cash flow from operating activities in the third quarter of fiscal 2019 and spent $76 million on capital expenditures during the same time period for free cash flow of approximately $1.4 billion. The company distributed $142 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 10%. Looking out over a longer time horizon, our conclusion is the same. Cardinal Health generated $2.2 billion of cash flow from operating activities in the first three quarters of fiscal 2019 and spent $192 million on capital expenditures for free cash flow of $2 billion. The company distributed $435 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 20%. Using free cash flow, our conclusion for Cardinal Health's dividend safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Cardinal Health's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Cardinal Health's performance during this time period is shown here. Cardinal Health suffered a 34% decline in adjusted earnings per share during the last recession. The company did not make a new high in adjusted earnings per share until 2016. On the surface, this looks really bad. However, most of this decline is due to the company's spinoff of CareFusion Corporation. The more important metric to look at is the company's dividend coverage. Importantly, Cardinal Health's earnings still covered its dividend payment, and the company continued its multi-decade streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Cardinal Health's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate would have to increase before its free cash flow would no longer cover its dividend payment. At the end of the third quarter of fiscal 2019, Cardinal Health had $9.1 billion of total debt outstanding. The company generated $75 million of interest expense in the most recent quarter for a weighted average interest rate of 3.3%. The following image shows how changes to Cardinal Health's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Cardinal Health's weighted average interest rate would need to rise to above the 26.6% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Cardinal Health's dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on Cardinal Health's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.